The national elections are finally over. How will the markets move forward from here? What is going to be the role of interest rates and Fed policy? All of that in our discussion on the markets today. Now, before the elections, the trade setup was very, very interesting. I think I did a couple of videos around it, and I showed that not only the short-term sentiment, which we measure with, the momentum swing, was getting to extremely oversold readings again and again in every sell-off, and especially in the 2 days prior to the election results and the exit polls. And then if you saw the positioning, simply go to strike sentiment indicators and you look at the FII short position, it was the second highest on record. The client long position was the highest on record, which means the big, large, smart traders and investors were betting on a positive outcome from the election results. Now, of course, the exit polls give them a thumbs up with a pop-up. Then you had the actual announcement. And if you'd studied history, and I'd mentioned it, that there's always profit booking on the day of the election results because it's buy on expectation, sell on news. But definitely, even I didn't expect it will be a 1500 point kind of a move. I just thought it will be pulled back to 22,400 worst case scenario. We ended up touching almost 21,300 or some, just below that maybe. That ended up kissing weekly bands, weekly averages, and in so many stocks, it ended up being the final shakeout from this move that eventually they've all moved to new highs. Now, what is important in this whole process is something we've been saying over and over again, and it is called stock and sector rotation. So there are couple of ways you can do it. I do it looking at my RMI indicator. So when I see that the daily and weekly RMIs are not in alignment, which means the weekly has a sell signal, and especially after a couple of divergences, negative divergences, then that is a setup in which you actually want to reduce your exposure or not be aggressively long. I mean, surely that doesn't mean it's the end of the bull run for those stocks, but it means they can consolidate a little longer and you need to wait, even though the daily charts may give you triggers. But then there are others where the daily and weekly come into alignment. And there are also those where the weekly cycles are complete, which means the prices have already corrected a lot and they are just picking up, which could be the start of a completely new cycle. These are the places I would like to get interested in because rotation is a fact. It does happen. We've seen it over and over again since COVID, even in the prior period, but very, very much since COVID. Markets have gone ahead in every leg on the back of different set of stocks and sectors. And just like PSUs, for example, this year was a hot moment. In 2020-21, it was the metals and various other commodity related sectors that did extremely well. And then you had the hotels and other sectors start doing well, hospitality, because of the post-COVID travels that everybody was doing. So you've had a different mix of things doing well at different points of time. You've had different mid-caps also perform. You had the EV theme, which was really hot and running post-COVID. Now it is not being talked about so much, even though it is still around. So we are again going to see these kind of shifts. And that's why I mentioned these divergences. For example, the PSU index does have this kind of a divergence where, weeklies are negative and dailies are, giving buy-sell signals. So those are places where I would think that, PSUs were essentially an election rally. I've been saying this in my media interactions also. So post the election, can you keep running on the same theme? The answer is now it's going to be a mixed bag. I mean, unless there is a stock specific reason for it to make that run, it will probably consolidate for a while. And money will find new places, new sectors to actually go into. Now, that also means that there are some sectors that are slowly picking up in the background. Like I always like metals. You're seeing commodity prices pick up in the last quarter. There's been a short-term correction recently. And this has mostly happened around the Fed meeting. But now that the Fed meeting is behind us, we can sort of get clarity on the dollar bond yield commodity cycle part of the story, which is something that I personally have liked since COVID. And I think I'm liking it all over again because we should be starting longer term into a third wave within this sector, right? So this is a very, very important data point overall to think about. So plan for sector rotation. In fact, one thing that we have done is we have released on Strike something known as relative rotation graphs. If you don't know what RRG is, then just go and try it out. And also you can study, you can Google on it, because this is a tool that has been on platforms like Bloomberg or Reuters, big platforms that are very expensive for retail investors, and we've actually brought it to Indian investors on a retail platform with Julius D. Kempner, who's the creator of this tool. actually giving us the license, and he's going to be doing a webinar tomorrow live over YouTube, Twitter, and various platforms. So don't miss it out. Do watch it. You'll get an idea how you can make your portfolio outperform in these markets by capturing these changes in sector rotation, not only sector rotation, even stock rotation within your portfolio. So you can actually create a watch list of your portfolio or a group of stocks and watch the rotation happening inside it and decide where to increase weightage and where to reduce weightage. Very, very interesting. This is what the big portfolio managers all do. And now you have access to that tool on strike. So you should try it out and attend the webinar so that you can learn how to use it. Otherwise, sometimes it can be overwhelming, though it's a simple chart which simply shows, prices moving around 4 quadrants, outperforming, underperforming, and so on, in the form of leading, lagging, weakening, and gaining. So once you get a hang of how these quadrants work and how prices move within them, when should you increase, reduce weightage, how should you handle your trades, that will help you. And so that is what Julius is going to take you through over a series of webinars. Tomorrow should be the first one of the series, and there will be many more to come, so don't miss that out. But this is an important part. I also have been doing this with RMI, which is basically momentum. What RRG does, it looks at relative strength and relative momentum both on an X and Y scale and plots it, which makes it much more interesting. So on a momentum basis, I do see rotational effects where there is weekly momentum weakening and then there's daily momentum gaining. And I like to look at those as places where there will be a consolidation, but there are sectors which are picking up. For example, FMCG, right? It went through a deep correction, Jan, Feb, March, April, correction is over. Weekly momentum starts picking up. In fact, when I did a heat map video sometime back showing that the FMCG was outperforming when the correction happened in April, right? From 30th April to 13th of May. In that correction, if we simply do look back on what kind of performance we saw between that time period, on the heat maps on strike, you actually see FMCG and MNC on top of the list. And so that is a sector that has started to make a comeback. So that's how we try to identify, there are different tools and ways you can try and identify something coming back. But I'm sure RRG will, make up for all of that, because you can, look at an entire basket and where it is in its journey over an entire period, over a year, say, for example. So prepare for a rotation. That is what is going to happen. I've been getting asked questions even about IT sector. It's been beaten down. Will it come back? The answer is yes. Banks have not been performing. Will they perform? You cannot have a bull market without banks. And so we are going back to a bullish mode, which I think will continue not just into the budget, but probably after the budget as well. Now, of course, the index, because it had such a wild move in one way, you are seeing it, really narrow down. That is something I was saying will happen. I was only not expecting the very sharp rebound. I thought it will rebound and then consolidate and then pick up again. The rebound is sharp, but again we are consolidating because VIX, the volatility index, had to come off. Again, it's a similar pattern to both the previous elections. The VIX almost doubled into the election, and then once the election results were out, it went back to the point from where it went up in the last leg. So earlier it was from 14 to 28, it had gone up, it came back down. This time it's gone from a low of almost 11 all the way to 30. Will it come back to 11? Well, I would be comfortable once you're back in the sub 13, 12 kind of range. You're already at 14 point something yesterday. I've not seen the live data today. But if you're getting there, then I think most of the high volatility readings are off the charts, and now you can trust your charts more. But what the Nifty will do is, because it's already made a big move, it will consolidate for a while, frustrate you, because that is its job. And in the meantime, then you'll be forced to look for stocks that are outperforming. Not always an easy job. You're seeing that happen in mid caps and small caps every day, but you're not seeing it across the board in the index stocks anymore. So that requires a little bit of focus. I think it could happen in metals. So that is one area I'm really checking out, because like I said, this correction looks like sort of done as far as the commodity prices are concerned, and it's also coinciding with bond yields rolling over. So my biggest fear, why some people think you are bearish earlier, how did you really turn bullish? And the main item which I was watching, the main macro data point which was scaring me in Jan or last year since October, was rising bond yields. I thought bond yields had topped out and bond prices would rally, but they started to give back in October. Then they did bounce a bit, but again they started to give back after Jan, Feb, March, and we almost came to close to, but not crossed 5% this time around. Now it looks like bond prices have reversed. They've broken the rising trend line. So I would like to think that bond yields have finally made a lower top and they are starting to fall. And you're seeing that even after the recent Fed meet, after the recent CPI data, yesterday you had PPI data, all of that is pushing yields lower. You only saw the dollar bounce around both ways because of some problems in Europe. But once you have lower bond yields and you have a falling dollar, then you've sort of created the environment not just for commodities, but also for emerging markets. Something that we saw as a major trend going on between 2001 and 2011. Of course, 2008 was the GFC. But even after that, you did see new highs in certain commodities like copper, not in oil, but in gold and silver. And so the final peak for the commodity cycle was only in 2011 for all the commodities. Now, since then, we've seen commodity prices fall. Oil went back from a peak of $135 to sub $10. Even in futures, it traded negative during COVID. So we had an entire down cycle. Now that cycle has turned all over again. And I've been writing about it for months now, that wave 2 has to complete in commodities. I think it finally has. You've seen the first bump up in the commodity prices. We are now seeing the first correction. The next move should be due to start anytime now, because we've seen a pullback now in copper, silver, gold, everything is sort of pulled back, even Bitcoin, and which has also become now an asset which sort of reflects the global liquidity situation. And so everything is seeming to move with liquidity. Liquidity increases, not just Bitcoin, but most commodities and equities start moving higher. So they all sort of give signals for each other as to what is happening. But the commodity cycle does relate a lot with the dollar part. Equities don't always. Sometimes equities can go up with a rising dollar as well. But commodity prices are very sensitive to movements in the dollar, which is why yesterday they were down, even though bond yields were down because something happened to the euro and caused a dollar spike. So that was what the overnight effect was. But overall, I think yields are heading lower, dollar is heading lower. So start looking at Indian bond yields, because see, that is what really bothers you, right? In India, you really want to know where is the 10-year GSEC heading. And my sense is that the 10-year GSEC heads, once it goes below 7% and sustains below 7%, we had done that just before the election results, and then it spiked up on all the news. But now it's starting to fall again. And once it sustains below 7%, I think you're on your way to going even below 6%. Or who knows, you'll go back to 5 eventually. So if you're going to see significant cuts in rates in India, and interest rates start falling, you get an entire trigger across interest rate sensitive. So that is the second thing you'll find I've spoken in a couple of my media interactions, that interest rate sensitives as the place to focus on. That's a lot of sectors, right? You have real estate, you have autos, and then you have infra where investment will happen, the capex cycle. All of these things are so linked to the interest rate cycle that it's very interesting. And I think the only reason why RBI did not cut rates at last week's meeting, the Reserve Bank of India should have done it, would have done it, but they have to wait for the budget, right? They want to actually see numbers. Even the CPI in India has come lower, but they want to see numbers. They want to know what the government spending is, how much they're going to borrow, even though they've given a big dividend to the government, which essentially lowers their spending, which is why yields fell sharply in between. But I think they still want this final thing to happen. And once they know what that program is, what they're going to spend, then I think they can very clearly see how monetary inflation will play out, and then accordingly adjust interest rates. But my sense is it's a question of time, right? Like just like the US Fed, which is promised that yes, we are going to cut rates, and then they don't know when, and so they're waiting for data to set in somewhere. They've gone from saying 3 to 1 to 2, but the point is they want to do it, and the markets are pricing that in, that eventually rates are headed lower from here, and everybody's trying to work around that eventuality and move towards it and adjust according to that based on their portfolio. So nobody's taking it negatively that rates are high. Instead, they're thinking that if rates are going to go lower, then things are going to look better 6 months from now. And accordingly, in India also, I think once the clarity comes up, and I think in my mind it's clear rates will head lower in India as well, then accordingly those sectors will start pricing it in much faster. And you're already seeing that momentum in auto stocks there. The auto index is almost near the all-time high. Metals has started to move, which is also sort of sensitive to these macro headwinds. And you see it in real estate stocks. They've consolidated for a couple of months, but I think the momentum has started to pick up there as well. Capital goods and infrastructure stocks have heated up a bit in between, but I think they'll get their real trigger when actual rate decisions happen, because they actually need to borrow large amounts of money to invest for the capex cycle and for the private sector capex cycle, right? You hear a lot about that. Government is doing all the spending over last couple of years. In this year's budget, they actually reduced their capex percentage growth year over year, although it's still a large number. Instead of 30% like last year, they did 10%. Now they'll probably continue that for the rest of the year, but somewhere that has to shift towards private sector, and that will happen when rates go down. So that's the linkage, right? That's what makes it important. When it becomes affordable for you to borrow and invest in further capacity, you will. So that's how all these things are going to play out, and markets, like I said, ahead of the curve, prices start moving even before earnings start growing, in anticipation ki yes, this is what is going to happen in 1 year, 2 years. The smart investors position themselves, and that is why you need to anticipate some of these trends. And if these trends are visible on price charts, then we look at price charts and move with them. And the best way to do it is look at not just the RMI, that is the first tool that I suggest on Strike, and the second is Strike valuation setup. For those of you who are fundamentally inclined, for every stock or sector that you find moving, it's good to really go and look at the valuation setup and see where the valuation is on a historical basis. Is it really become overbought or not? Because there are stocks which are not necessarily in the overbought readings. You might find some of them, some PSUs, for example, maybe well above 2 standard deviations on their valuation. But there are others that have still not gotten there. The PSU index itself is still close to, but not yet there. So that's because it's a long-term cycle, right? It's not something that plays out immediately in one move. And there was huge undervaluation also in PSU stocks. When interest rates actually went up in 2022, that is when everybody started to talk about shift from growth to value, and that is sort of what you saw play out in that space, because there were a lot of value and that got unlocked. So again, can there be a shift from value to growth? So then again, you start thinking about that, but you have to see growth at the right valuation. Sectors where there have been corrections, stocks where there have been corrections. In fact, I have found stocks whose prices are going up very slowly and valuation is falling because earnings have grown faster than price and money has gone somewhere else. So we have not fully discounted the growth that is happening. And if you can spot those in the Strike valuation setups, they will be very useful. What we will do though is we will come up with scan tools where you can actually scan some of these metrics and quickly come up with which stocks are showing this setup. I know that is what everybody wants, but right now you can actually go and look at it, at least in stocks that you like or portfolio that you have, and take those decisions. Eventually you should be able to find new ideas using these scans as well on the valuation metrics. So that's all I think I'll leave you with. A lot of things to think about that are happening. You have a commodity cycle picking up, you have interest rates going to go down, and the stock market in the short term is just consolidating, waiting for the next trigger. But one of the triggers is a lot of liquidity in the market that has to chase something or the other. And I think there's going to be rotation from some sectors which were moving up a lot, some stocks which have, which may stop growing at some point of time, to others which are still growing, and those which have gotten beaten down and where the momentum is still good, or the trend is still good long term, or the valuations have come down long term. So this is what is going to happen in my understanding. The bull market essentially continues and goes on, takes us to new highs. You just need to get yourself positioned appropriately and participate in the move. That's all from me today. Thank you.